All right, good morning. Welcome back here to Trader Minute. Great to have you aboard. As I mentioned this morning, I was going to kind of sit back, watch the markets, see how things were ticking along, and just kind of a look for some observations here. Not so much analysis, but more observations, as we are dealing with a historic time period here. And I did something I didn't expect to do this morning. I did go out and buy a few things, just long term stuff, added some exposure. I do need to figure out a way to hedge it a little bit, but I'll show you some of the stuff that I went and grabbed, here with it. But, as I'm watching some of the market here, there are just some key observations that I think are important here today to understand and to consider when going forward. All right, so let's start with them. Let's start with number one: ridiculously high implied volatility. The VIX here is in the 70s. It's pulled. Well, no, it hasn't pulled back much yet. It's at 77. It's a ridiculous number, an absolute ridiculous number here. And, if we go and we put it into some sort of comparison to other time periods, we talked about it when it was in the 50s and 60s, that it only compares to the financial crisis. And, yeah, that's what we see. It only compares back here to 2008, 2009, the financial crisis there. It doesn't compare to the, to the dot-com bust. It doesn't compare to 9/11. It doesn't compare to the Euro crisis. It doesn't compare to anything except for the financial crisis, which is pretty remarkable. What does it mean? It means options are absurd in so many ways. I was watching Halliburton this morning. And I was watching it thinking, you know what? I wonder if we'll see a rally this morning. I wonder if I can play it. Just a little bottom picking. And all right, let me go price out these options and see what they're up to. And I went into the option chain on Halliburton and looked at this week's options. And the first number that stood out to me was this number over here on the right-hand side under volume. This is the implied volatility, 236%. I've traded Halliburton for many years. Normally, the implied volatility, a high, is in the upper 40s. But it's been as low as the mid-30s. 236%. That means if I go and buy this 650 call at 86 cents and the stock rallies 10%, I could still lose money. It's incredible. It is just absolutely incredible. And it's not just limited to Halliburton. Take a look at Boeing. 186% implied volatility on Boeing, a Dow stock. 186%. These are going off charts, meaning we can't go back and look over history and go, oh, well, it's had this implied volatility before. These are record implied volatilities right now, and that is observation number one. So what does it mean? It means that as I look at things, options, options not as great as what they would seem. Right. Yes, am I going to get some movement? Sure, but if I don't, or the movement's only a little bit, then I'm not going to get paid very well to the upside there for it. Okay. So that's observation number one. Options are insane. It doesn't mean the prices aren't moving, but you better be really short term in how you're trading it. Overall, if you're going to do a long call or a long put. That just means that going out and saying, well, let me go buy some GM and I'll hold some GM calls for a long time, you're not getting really good value at all in any way, shape, or form. And the first time that implied volatility starts to deflate, it's going to ding the options very, very quickly. Right? Number two, some logic is coming back to the market. You say, wait, we're talking about a market that gapped down, was halted, has made a 100-point rally, has had 40-point declines. Wait, logic coming back into the market? Yeah, some logic is coming back into the market. We had some stocks that held up and went green early on this morning, and they were the stocks that would make sense to do so. Last Thursday, when we had that record down day in the market, Kroger didn't get bought up. Today, Kroger's getting bought up. There's a food company, General Mills. It's a food company. Last Thursday, not bought up. Today, getting bought up. SJM, similar sector, similar action. Procter & Gamble. There's a little bit of logic coming into the market as far as what's being bought. It's not the market going out and buying and saying, "Oh, I want to buy the tech. I want to buy this tech dip." And yeah, we're seeing a little bit of that. But they're not taking these to an extreme level on the upside. We're seeing the green stocks in general be some of the more logical names out there. And we are seeing a little bit of return to logic is what I would call it. We're seeing some bargain shopping. Some of the stocks that are super inexpensive, starting to get bought up. So we're starting to see a little bit of logic come back into the market. Number 3. There are stocks in this market that have become insanely cheap. Let me show you what I mean. Let's come in here to FinViz. Let's come in here to a screener. And I'm going to come in. I'm just going to look at the S&P 500. And then I'm going to come over to Fundamental. I'm going to look for price to book. And I'm looking for stocks in the S&P 500 that have a price to book that are lower than 1. What does that mean by theory? That means that the company could liquidate everything and its shareholders would be compensated with more than what the stock price is. Going below 1 is not a common thing for most companies, and staying below 1 is not very common for long periods of time. Now, we do see it from time to time, but right now we have 86 stocks in the S&P 500 that are trading below a price-to-book value of 1, meaning their stock prices are trading below their actual book values. Now, not all book values with all companies are the same, so there's a lot of different things that can be pulled out of this. But the sheer number of stocks trading below book value right now in just the S&P 500 it is pretty insane. Bank of America, Ford. Ford is not one I want to touch. But Carnival Cruise Lines, we'll come back to that one. Southwest Energy, Wells Fargo, Exxon trading below book value. I have to go on a little tangent here. My apologies. Let me come in. Let's see. Has Exxon ever traded below book value before? Let's come take a look. Fundamental chart. And let's just come in here to book value. And we'll just go annual. Let's go max data. And let's see. We've got to do price to book to give the right comparison. My apologies. There we go. Price to book. Has it ever been below 1? Nope. This goes back to 1984. And the price to book value of Exxon has never been below 1. Ever. Not in the financial crisis, not in some of the oil dips into the 20s, not ever. Never. That's how historic we're seeing some of these things, be. If you come in and you just take a look at the dividend yield on it, which we've already talked about, I don't want to buy a stock based just because of dividend yield. Have we ever seen Exxon yield at 10%? 10%. We're talking about a stock that's trading below book value with a 10% yield. And I know there's some shocks to it right now. But we're just talking about historically cheap. Absolutely historically cheap and in a ridiculous fashion. And there are many on this list that qualify into that. You can see why. United Airlines, yeah, it makes sense with what's going on, all the uncertainty. But Morgan Stanley, Regions Financial, Goldman Sachs is on this list. You come in, Berkshire Hathaway's on this list. Key Corp, which is a regional bank, is on this list. It's gone from 20 down to 10. We are seeing some ridiculous valuations, and I know earnings are going to drop, right? We're talking about a recession that's coming and all that. Everyone likes to use the recession word right now, and the recession is coming, and yeah, they're right. A recession is coming. We are going to see the quarterly dip in economic data. But is it a recession that fuels greater contraction in the future, or is it a recession that's kind of a 1 or 2 quarter dip? If you believe it's a 1 or 2 quarter dip, these are some of the stocks you're looking at and saying, how do I pass them up? How do I pass some of these names up at some of these levels? Capital One, there you'll notice a lot of gas companies, oil and gas, and they're not all made equal. But you can go out and get Exxon, which isn't going bankrupt, which isn't going under, which isn't going the way of the dodo, and get something that is absolutely historically cheap. I don't know that I'll be able to resist grabbing a little bit of Exxon, into the close today. We'll see kind of where it all is, but historically cheap. That's observation number 2. Observation number 3 is that. Observation number 4. Take a look at where some of the money is going today and think about stimulus. Think about what governments around the world are going to do in response to this. Because that's the age we live in. We live in an age of government responses, of Fed responses. Market's doing this, so we have to respond with that. What's been the typical U.S. government response to dips? The House, the Senate, the presidency. What's been the typical response over the years? Well, the typical response has been a stimulus measure to create jobs, and many times in construction. So what does that mean? Well, we come in and take a look at some of the construction names. Vulcan Materials. A lot of times stimulus is targeted that ultimately benefits a stock like Vulcan. If we come back to a monthly chart here, you can see where some of the fiscal stimulus that came in play back here in 2013, 2014, pushing construction really kind of helped Vulcan Materials. Martin Marietta, same difference there with it. You could throw Caterpillar into this. Just because from a global standpoint, very likely that we will see any sort of stimulus package that is proposed or enacted be something that's a high benefit to a Caterpillar or a John Deere or some of these construction names. That's the historic norm. But we're in a little bit of a different dip right now. This isn't a dip that's, causing jobs to go away. Yes, a lot of temporary jobs and hourly jobs, yes, are going away, and we will see a big uptick in unemployment. But what is the kind of the crux of the matter going on out here? Well, I was at the store the other day, and the meat counter was completely gutted. It was completely empty, and I was talking to the butcher and just talking about what was going on. He goes, "Yeah, we did $400,000 in sales the last 2 days." Now this is a small neighborhood grocery store. For them to do $400,000 in sales on any given day is absolute record, absolute historic for them.
and they did it 2 days in a row. Well, what's the result? Well, their inventory's gutted, right? The shelves are empty, and I asked them. I said, "Now, are you expecting to get more product in, or are you seeing some sort of issues with getting product in?" And he said to me, the truck was supposed to be here at 6 o'clock this morning. It's not coming till 6 o'clock tonight. We are starting to see issues of just lack of drivers for the trucks. I thought that's pretty interesting. And you've probably seen Facebook groups and all those other groups talking about trucks delivering to stores and when the trucks arrive and all of that. And it's one of those where, as long as the trucks keep going, the well-being of most citizens is going to be okay. We'll survive. We'll get through. If the trucks stop and the stores stop getting stocked, then what happens? Now you start having a very big panic scenario. So you think about where the government might step in to throw some stimulus, some added protection, some added incentive. That's into the trucking industry. And if you think about these truckers, what's happened to fuel prices? They've plummeted. What's going on with some of their demand? Well, in many cases, it's increasing, but it's also one of those where less economic activity, there's some things that aren't being shipped and things like that. But I would be very surprised if some sort of stimulus measure is not targeted at the trucking industry here in the U.S. It makes me look at companies like J.B. Hunt, Old Dominion, ODFL. These are two that I tend to watch. Knight Transportation's another. These guys have more of the refrigerated type of vehicles than some other companies out there. And where you can start to see some real value. You see the story of fuel is going to significantly help them going forward. And while, yes, the economic dip, the overall activity that's going on has certainly hurt this sector, it could easily be one of those sectors targeted by government with stimulus. And so as I look at the truckers, as I look at construction, I want to have a little bit of exposure there with those. So that's point number 4. Now point number 5 here is the VXX is untradeable. I tried to go into the VXX today. I talked about this last week. As when things settle out, the VXX is going to pull back aggressively, and talked about using a put spread to play it. The problem is right now the put spreads are just ridiculous, and there's just no real getting into them with any sort of decent value. If we look at the May put spreads, I can come into something like the 40 and 41. And it's going to cost me, I'm going to be spending 50 cents to 60 cents to get into that and into something that's going to be worth $1 if I'm right. And, it's just one where the risk reward doesn't make much sense. They have priced these to where they're saying, get out of here, go away. We're not giving you free money, and, move on. And that's, saddening. I don't like to see that. I was hoping to be able to get involved. I did go look at some January 2021 put spreads, but you can see the spread on the options here. So to get a decent price is going to be very difficult with how wide the option spreads are here with them. Okay, so I'm not jumping in, not trading the VXX here. Like I talked about last week, I will be looking at it, and when I get a chance, I will look to take it. But so far, it is not there. Some stocks that have caught my eye here, right? Those are the my big 5 observations here today. Some of the stocks that have caught my eye: Caterpillar, which we talked about already. This is one that is trading back above Wednesday's closing price. And I think there's something to be said for stocks that
today are trading above Wednesday's closing price. There's a significant outperformance that they are seeing here overall. Netflix holding up incredibly well. It's not trading above Wednesday's closing price, but holding up in this 300 to 320 area. IBM went green here for a little bit. It subsequently has pulled on back. But we're starting to see some high volume supporting of some of these stocks come in. We have seen many of these stocks just rally on rallies, but we're now seeing some individual volumes come into some of these names. And some of these names that on the Dow are down 30 to 40%. And some interesting action. Now, I did go get into a position today. I bought some Royal Caribbean. Yeah, I know. Probably insane, probably crazy, and I'm not advocating for anyone to follow me into this trade at all. But I bought shares, and I bought not what I'm willing to lose, but I didn't buy it with a certain stop in mind. I bought it for hey, I'm going to let time play out, and it just, I may catch lightning in a bottle, and I may not. And I decided Royal Caribbean over Carnival, but both of these are the same thing. Carnival would be a little bit cheaper on a share price basis here. But both of these companies, Royal and Carnival, let's just take a look at Royal. 10% dividend, which I'm not an advocate of buying for a dividend. That's just ludicrous right now in this market. We talked about it a week and a half ago that dividend buying isn't the way to go. I'm not buying it because of the earnings per share next year, because those are going to come down. The estimates are going to come down. It's going to be one where they're going to just they're going to have an opportunity to kind of throw everything bad that the company's been carrying into a quarter. Book value is $58. They're trading at $33. It's a company that has pretty decent cash. They're going to survive all of this. They're not going under. They've been able to tap some credit facilities here. But, yeah, we have a company that basically has said, we're not going to be in business right now. We're out of business right now. We're not operating, period. So every reason for the stock to tank, every reason for the stock to trade down where it is. But I also know that at some point in the future, the panic will subside. Business will get back to what it was. I can't expect it to happen tomorrow. I can't expect it to happen this month. I don't expect it to happen next month or the month after. But at some point in time, some of these stocks that are ridiculously cheap, to me, are worth a little bit of a flyer. Unfortunately, can't really do it with options. Can't really pick these up and say, well, let me go buy some Royal Caribbean call options. If I just go out for a year on Royal Caribbean call options to the 35 strike, they're going for $15. That means I need the stock to trade over $50 to make any money. At 65, I double my money. At 65, I double my money. Well, I can buy the shares, and at 60, I double my money, and I don't have a 3-month window, or a 1-year window. I have a longer window. Plus, I get the dividend, which is 10%, probably will get cut. But overall, it's one where the options just don't make sense. They simply do not make sense. Okay, I'm willing to step in with a few shares. And I couldn't resist today with just where some of the historical cheapness is. Again, if you're dip buying, you need two things: a very long-term perspective and a stomach to watch them go lower if they do. Because there is nothing about today's action that says, ooh, bottom's in, off we go, with stocks, with the market, or anything of that nature. So as I look at the market today, it's more of the same,
But, some of those observations, just absolute historical implied volatility, a little bit of logic coming back to the market, some targeted stimulus probably coming, and, some ridiculous cheap values. Have some things that may pay off very well, going forward. And while I do not expect a headline that says miracle cure found for coronavirus, if we do get some sort of headline that there's some sort of treatment, that there's some sort of vaccine in the pipeline that's legitimate and usable for the next 3 months, some of these stocks could see some very rapid ascents and some very rapid recoveries, and rapid to the point where there's no time to get in them if you didn't buy them on the dip. Thanks for hopping on. Sorry, before I hop off, one last thing I want to show you. There are no 3-7 crossovers here today. Not on the bearish side, not on the bullish side, so no fresh 3-7 crossover action coming in there. So it means I'm not going to have a challenge trade here today. Also, no real change in the market metrics. Market metrics are still very, very bearish, historically bearish. But we do see the bullish percent index snapping up a little bit, but nothing to a tune where it would change anything. And a few stocks moving back above sevens, but not in a way that is going to change the signal on the market vibe. It will change the number slightly, but not the signal. But you see only 23 stocks in the S&P 500 trading above their 7-day moving average. And some of these just very interesting names. UPS, Oracle, just very interesting names. But if you're looking to kind of, buy some dips, take a look at some of those super cheap stocks. Take a look at some of the stocks that are actually trading above their 7. I think those are going to be some of your better options, here in the short run. Again, thanks for hopping on. Have yourselves a great one, and we'll talk to you later. Take care.